Good morning, everyone. And welcome to our latest session on the future of investing. This is a continuing series, and I'm very happy that Brian has assembled such an outstanding panel. Let me just move right into the introductions, because we've got a very, very high caliber panel. I know you're going to want to ask a variety of questions. To Brian's left is Jim Rowley. Jim is a senior investment analyst in Vanguard's investment strategy group. In this capacity, Jim leads the team that conducts research and provides thought leadership on issues related to indexing and ETFs. Before joining Vanguard in 2005, Jim worked at Gartmore, Lehman Brothers, and Merrill Lynch. I guess in your case, to Jim's right, we have Adam Duncan. Adam is head of portfolio modeling and quantitative research at Cambridge Associates. Adam is the leader of Cambridge Associates portfolio modeling and quantitative research groups, and as a managing director in the firm's Boston office. Adam specializes in portfolio risk modeling and manager research. He focuses on investment opportunities in diversifying asset classes, including CTA and managed futures, alternative beta, hedge fund replication, risk premia and tactical asset allocation, volatility trading, and discretionary and systematic global macro. Adam also actively researches factor replication, skill detection, asset allocation frameworks, and failure survival probabilities on an ongoing basis. Adam is a frequent presenter at industry conferences and guest lectures at a number of universities. And to Adam's right, and rounding out the panel, is Andrew Ng, Managing Director at BlackRock. Andrew is the head of factor investing strategies and leads BlackRock's factor-based strategies group. Throughout his career, Andrew has focused on identifying and harvesting factor risk premiums within and across asset classes. Before joining BlackRock in 2015, Andrew was chair of the Finance and Economics Division and the Ann F. Kaplan Professor of Business at Columbia Business School. He has published widely on equities, fixed income, asset and factor allocation, and alternative assets. Adam's recent book, Asset Management, A Systematic Approach to Factor Investing, is a comprehensive guide showing how factor risk premiums can be harvested in portfolio design and incorporated in all aspects of investment management. Brian, please set the stage for us today.
Okay. Well, thank you, Ray. I really appreciate it, and thank you all for coming today. I think we've assembled, as Ray said, a great panel for you, and we'll get a chance to really dive in here, and I think we'll all learn something new about factor investing, which is a pretty fast-growing new area. So thank you to our panelists for coming today. We do have a very esteemed group here, and I think we're going to really try and shine a light on this topic and examine it from all angles, the good, the bad, all the nooks and crannies here, and then just really see and make sure that you all leave here sort of understanding exactly what's going on and where this is all going. As Ray mentioned, one of the panelists has written this book. Andrew wrote this book, The Systematic Approach to Factor Investing. I think if you shoot him an email after, I'm sure he'll probably send you a copy of it. If you really want more on factor investing at the end of it, it's quite an interesting read. I haven't read every page, I have to admit, but I've read a lot of it. But it's actually really, really good. So just a few observations before we start. Obviously, the rise of passive investing is pretty dramatic right now. Greenwich Associates just came out with an interesting paper talking about the shifts in institutional investment portfolios, and it's quite profound. And Jim's right here from Vanguard. He's obviously seeing it. We're seeing it at BlackRock. The numbers are staggering. They're massive. There's implications of that or from that for factor investing, and we're going to get into this question today on factor investing. Is it passive investing? Is it active investing? Is it somewhere in between on the continuum? So that's one of the big questions we'll get into today. But just to level set a little bit in terms of definitions before we jump in, and I think just knowing a lot of the people in the room, I think there's some varying. Some of you are incredibly familiar with this topic and have read Andrew's book, and others less so. So I wanted to just maybe throw out a couple of definitions before we jump in. One is that on factors, they capture investment ideas that have been well understood for a long time. So, we'll talk about the new aspect of this in a little bit, but they're embedded in traditional and active and passive strategies. These are well-known, broad, predictable patterns of returns that explain outperformance of certain securities. So things like value, momentum, quality, carry, size, curve, vol, etc., real rates, inflation. They're observed across asset classes, in equities, in fixed income, basically every single asset class, commodities, currencies, and even in private markets, in real estate and private equity. And you also can now access these through smart beta type strategies in ETFs that are really simple to trade, but also through more actively managed multi-asset strategies as well. So multiple different versions of this, and we're going to explore, and I'm going to ask as we go through on the panel, each of them to basically redefine in their terms exactly what they see as well on factor investing. So I think what we'll do here is we'll have each of the panelists will speak for a little bit. I'll ask some questions. I have a bunch here. And then at the end, we'll have plenty of time for you all to ask questions as well. So with that, I think as we turn to Jim, one of the obvious questions, and I was touching on the newness factor is that actually this is not necessarily all that new, because Graham and Dodd, speaking of Columbia University, were teaching on value investing in the 1920s. So what's the excitement? Why is there so much focus on this right now, Jim?
Microphone?
Yeah.
Thanks, everybody, for your time today. Appreciate it very much. And when we think about factor investing and whether or not it's new thing or it's different, I like to look at it in terms of it's not necessarily anything new. And whether or not we want to go back to the 20s and 30s about recognition of certain factors, I might actually say that the modern era for the practitioner to start working with factors started when Morningstar came up with their 9-box. And we can talk about whether or not that's a retail-y concept, but for a large research firm to acknowledge mutual funds purposefully manage to a size mandate or a style mandate, and we'll probably have a further discussion about the proper definitions of small and value, but to me that kicked off the modern era, if you want to call it, of practitioners dealing with factors. So I'll talk a little bit about, from a practitioner standpoint, the fact that this isn't necessarily anything new. We in our professional careers have all been dealing with this. But usually I feel really old at work working with some younger gang. So to say Morningstar kicked off their 9-box when I was still in college, this is one of the few times I feel young to talk about that. But nothing's perfect and nothing's necessarily great. There are some challenges with this. As this practitioner dealing with factors has spanned traditional, what we might call traditional active management, all the way to this current day phenomena of indexing, and is indexing taken over the world, and there's still the additional aspect of factors with that. So we think about traditional active. Morningstar kicks off the 9-box, and we now look at both fixed income funds and equity funds in this grid. And oddly enough, with fixed income, I think some of the earliest factors we all ever learned was that if you take on credit risk, you should expect to earn higher returns. And if you take on more duration risk, you should expect, over the long term, to earn a higher return. And yet, in many ways, fixed income, we kind of disregard factors there as, well, they're not really factors, but there are. And if we took a vote, we might actually agree they're the ones aside from maybe the equity market factor, those two bond factors might be the two we would all agree, I believe in that going forward in the future. That seems to make sense. But for investors, that was a real way now to categorize funds and build portfolios. And on the equity side, it's the same concept. Investors now have been able to make decisions of knowing, I know this manager builds a portfolio on the basis of something more or less value-y and something more or less large. And so whether we think of that in terms of higher-end academic terms, it's still been a practitioner's way to work with factors, I'll call it, and build portfolios. Now, of course, the other side of the coin is there have been challenges with this. And the three that I sort of wrote down here to think about are, number one is that your factor exposure and your security selection have been bundled over time. And one of maybe the downsides of this 9-box grid is the categorization of funds and not really knowing, when I see my performance, what part is attributable to the factor aspect and what part has been attributable to the security selection effect. And that's actually one of the biggest drivers of the active indexing debate. When we see over a certain time period, X% of managers underperformed or outperformed their benchmark, active must be smarter this year. And if I left everybody with one tip today, I would say, think about what we call the style purity hypothesis. And it says that in a year or any time period, the better a sub-asset class does, so if you think about the 9-box, those 9-boxes that do better, those that do better, index funds do better than active. And the worse that sub-asset class does, you will find active to do better. Now, the reason for that is, as an asset class or a sub-asset class does better, on the balance, active managers tend to have more exposure not in that style box. So if you're sitting in a rising tide, but some of your fish are coming from a different pond, that's a headwind to you. So in many ways, I can make the argument that doesn't make active any dumber that year. That's a conscious choice to be picking securities not necessarily in your boxed-in definition. And the flip side is true. If you see a time period where active does better than that benchmark, but it's a time period where that sub-asset class is not doing as well, I would also make the argument that doesn't tell me that active is necessarily smarter in that time period. It tells me that there's a tailwind of a factor effect that may be counterbalancing any instances of security selection. So factors have had a great impact on how we even view that traditional active-passive debate. And again, the big starting point here is the bundling and unbundling aspect of security selection and factor exposure. The other two are cost and control. If you think about what we as investors would want to do, the cost aspect is, if you want factor exposure, you may say to yourselves, well, there's a certain price point I want to pay for somebody who is just delivering factor exposure versus the price point because I want to pay somebody for security selection. And that goes back to the unbundling. Just what am I paying for? Am I paying for security selection or factors? The third one being is control. The era of 9-box investing, if you will, comes with it. Maybe you pick a growth manager and you find out they're GARPy, not super growth. Or you find somebody to be value versus deep value. Even within that 9-box, you're competing a little bit with how strong is the factor exposure, how not strong is that factor exposure. So that's a little bit of the modern era from the standpoint of traditional active. And what we see now is that playing field has moved over to indexing. And we see all the assets and cash flow that are going into indexing. And when I was here a couple months ago, I made the point that popularity, if you will, has just as much to do with active investing as it does indexing. Because that dollar that goes into passive funds doesn't go into one big, giant market cap weighted index fund. It goes into all these different pieces, small cap value index funds, short-term corporate bond index funds. This is investors now saying, I wish to remove the security selection from my portfolio construction choices, and I just want a factor exposure. And I would say the challenges that come with that are, number one, market cap weighted indexing as a means of achieving factor exposure. Maybe we could all call it it's factor light, it's diluted factor. Market cap weighted indexes in many ways are not built to maybe what we would say is the purest form to get that, or the most concentrated form to get that. Number two is these index funds, they don't come in long, short format. So again, if we thought about the real, pure academic discussion of factors, even these index funds that have long exposure, much of the return streams that you're getting are just market factor related and less about the specific factor choice. And three is the definitional aspect. Whether you pick CRSP or S&P or Russell, you have to compete with everybody's sort of different definition of what that factor might be. So there's a little bit of the challenges that come with the modern day indexing way to achieve factor exposure. But I think when you put those together in this idea that for a quarter century we've been dealing with factors in this modern era, it's a case of we have traditional active and we have what you call forms of indexing. And either way, they're coming together and blurring the line about, does that mean passive is about, or does that mean factors are about indexing? Is that a bit about active? And I'd say it's a little bit of both.
And Jim, what are you seeing in terms of the client interest? Is it more institutional, pensions or endowments, or is it retail, both?
In the worlds that I kind of described, I would say it's all across the board, but maybe different investor sets think about it different ways. I would argue the institutional crowd sees many of the remarks that I just talked about, and they would take that to be well understood and say, I get it, I know what we're dealing with. And they're embarking on this going forward chapter of the concept of funds that are built specifically with harnessing factors in mind. And I think if you move down the spectrum to the, through financial advisors and into the retail end, the retail end just might see, the benefits of low-cost market cap weighted indexing, and maybe they're not quite as in tune with the factor concept of it, but many ways they can get their arms around the basic idea of a value fund or a fund that owns corporate bonds and not treasury bonds. So it's maybe implicitly knowledge of factors, but maybe not at the level that we would be discussing or talking about.
Great. Obviously, Adam, from your seat at Cambridge, you talk to all investors, advise all investors all across the world, and you've spent a ton of time thinking about this. Do you want to start with the interest from investors and just what you're seeing out there, on the positive and the negative side?
Yeah, thank you. And thank you for having me here today. We are invested in risk premium strategies, and investors are, it's sort of across the board, as Jim indicated. And I did a little looking just in our public marketable investments. And our fifth largest investment in a single fund is actually a risk premium fund. And I was surprised by that. I wouldn't have thought that Cambridge Associates' fifth largest investment in a single fund would be a risk premium sort of based fund. And I was happy to see that. And the interest continues to grow. And we're continuing to do lots of work on it. But mine is more of a cautionary tale about factor investing. And I don't know, would you like me to go into that tale?
Sure, of course.
You can finish with Andrew. I think will be a much more positive view. Well, let me just say before I start the cautionary tale that I do think that it makes a lot of sense to view the world from a factor perspective. And my sort of story is about the difficulties with actually getting down from a factor-based view of the world onto an asset-based portfolio. Because the world doesn't present itself to you in asset form, or rather in factor form. It presents itself to you in asset form. So we start with a top-level factor-based view of the world, but eventually we have to get that down to a portfolio of assets. You can think about default risk, right? We get compensated for bearing default risk. But default risk lives in many different securities. So how should we harvest default risk? Which securities should I hold? What is the most efficient expression of exposing myself to default risk? So that's sort of the idea. And I think that what's happened generally is that a lot of difficult and hard work has been sort of swept under the rug when people talk about factor-based investing. And so I encourage everybody to take a factor-based view of the world. I think that is the right way to view the world. But I want to point out some things that are a little bit cause for concern, some of that hard work that it takes to get down to a portfolio of securities. So the first thing that comes up when you start to think about this, from my perspective, is that, and I'm in a very fortunate seat. I get to hang out with academics and practitioners of all sorts, so I get lots of different views. And one thing you notice fairly quickly is that there's broad disagreement about what the factor set is. There's no clear, if you go onto the MSCI site, there's something like, 2,000 factors advertised. If you pay the money, you can have 2,000 factors that explain the cross-section of returns. Okay. Cam Harvey from Duke wrote a paper in 2014 called Lucky Factors, where they canvassed the academic literature and identified 312 factors with significant T-stats that were published in academic papers in the last 20 years, just in equities alone. Right? So then Mark Carhart and his crew published a nice paper called Exotic Beta Revisited, 2015. And they identified and they walked through, it's a very nice paper, walked through 29 factors. And that formed the basis for their exotic beta product. And now it's up to 34 factors. We can keep going down. We can go to sort of the 5-factor Fama-French model that includes quality and low vol. We can go to the 3-factor Fama-French model from the original paper. We can go down to the CAP-M model, which has just 1 factor. So after looking at all of that, the answer seems to be that there's somewhere between 1 and 2,000 factors that we can harvest from markets. And there's definitely no clear sort of guidance on what we should do. So question number 2, why do you care about this now? As Jim pointed out, this has been around, these papers have been published for a long time. Practitioners have been doing different forms of this for a long time. Why is this such a hot topic right now? I think, sort of anecdotally, it feels like people are pretty bummed out about the shape of the security market line. QE had the intended effect of inflating asset prices. Forward-looking returns are quite low. You're not getting compensated for moving out the risk spectrum. And there's a shiny object over here called factor investing that can sort of save us, right? And I think that there's some truth to that. People are bummed out about the compensation you get for bearing risk. And this does potentially, and I actually think that there's some good reasons to think that it actually might help you. And I'll talk about that in a second. But Mark Kritzman did some nice work. Mark Kritzman from MIT. And he pointed out that to the extent that your factor definitions are just linear combinations of the assets, when you form an efficient frontier in asset space and then reform it in factor space with linear combinations of the assets, you get back the exact same efficient frontier. In other words, this isn't going to resolve any of the issues that you're feeling right now just by rebundling the securities into different form. And I think that's a good observation. When I saw that, I said, oh, that's a very interesting sort of insight. So let's suppose that we can just settle on some sort of collection of factors that we think makes sense, whether it's 29 or 12 or whatever. How do I think about which factors should I be exposed to right now? Or what's like a rank order of the most attractive factors to be exposed to the least attractive factors to be exposed to? And is that even a sensible thing to contemplate? Right? So if you take the sort of AQR view of the world, don't try to do that. That will lead to terrible attempts at timing. You're terrible at timing assets. You'll be even worse at timing factors. So just take the set and expose yourself to them at all times. Okay. But it would be nice, before we go investing in something, to at least know that we have a valuation framework where we can say, how expensive or cheap is this factor right now? And in all the interviews that I've done with risk premium providers, very few have provided a sensible valuation framework for thinking about each of the factors that they're trying to harvest. And that, to me, is caution. Andrew, I know, is one who is thinking hard about timing, and it seems very natural to me that the active management industry would have immediately raised its hand and say, yes, we can time factors. Why not, right? The active management industry is very cavalier about being able to time assets. Why wouldn't you try to time factors? It seems sensible. But it's not clear that that will be easy to do. Okay. Another question about valuation. I mentioned quantitative easing. Asset inflation as a result of quantitative easing is something that is sort of real and perceptible that we can see. A natural question is, have factors been affected by quantitative easing? Meaning, are most of the factors that you can harvest from markets also trading rich relative to their histories? Well, there's some evidence that suggests no. The discount factor, in fact, asset inflation is basically manipulating the discount factor on risky assets. We've manipulated the discount factor. We've inflated the asset prices. But in factor formation, the discount factor appears in both the numerator and the denominator. So there's an argument to be made that those discounting effects have left factors largely unchanged. And that seems to come through in the data a little bit. So there is some suggestion here that perhaps factor investing is something that has been less affected by QE manipulation. The last couple of points I want to make are, okay, so now we've agreed on the set of factors. We've attempted to do a valuation framework. We've taken a stance on timing. Now we have to put all these things together in a portfolio. Okay, well, when you start combining these things together, things get a little messy, and it's difficult. One of the things that Kritzman also pointed out is that when we form portfolios of assets, right, we have tremendous difficulty doing it. And the reason we have difficulty doing it is because there's estimation error in the parameters that go into the models. We have tremendous amount of error around our return estimates, our correlation estimates, our volatility estimates. It's a very tough thing to do. And when you go into factor investing, all of that comes with you. You don't get rid of any of that. And there's an additional source of error, which Jim sort of alluded to, which is this, what we call mapping error, right? So you come up with a portfolio of securities that you think represents small cap or value. But then when you come to work tomorrow and you hit the F9 on your keyboard, it's a different portfolio. Well, which one is it? What if it's moving around a lot? What if there are different definitions, right? So there's price to book is the classical definition of value, right, in the papers. But there must be a dozen other measures of the accounting value of a firm. And it turns out that if you use different ones, you get different experiences from investing in that value factor. So how should we deal with that? Which one should we pick? Is there a best one? Should we average them? These are all tremendously difficult questions. Another thing to observe is if you just plot the cumulative return of the classic Fama-French factors, you'll notice that the small cap factor is the worst performing factor. But it's also the one that has some of the broadest economic intuition, right? If we bear the risk of small companies, it seems like we ought to earn more money. So why is that the worst performing factor of the group? Well, it turns out that there's some problems with the way that small cap thing is defined. It turns out it has a pretty negative loading to momentum. So you need to clean it up a little bit. It also doesn't distinguish between a mid-cap company that it's on its way to being a small cap versus an emerging company that's on its way to being a mid-cap. The definition makes no distinction between those two types of situations. And that could be very different. So I think, just to wrap up, I think that taking a factor-based view of the world is absolutely the right thing to do. But I think that hopefully a few of these things has sort of stirred the thinking a little bit, that there's a lot of hard work that has to be done, and I think Andrew and his team are dealing with these issues every day. But that hard work is not to be ignored on your way to getting sort of a nice factor-based portfolio.
Thanks, Adam. It seems from what you're saying that you have to be aware of all these issues and the challenges, but then implicitly that is it the sort of risk management aspect of it that you find appealing, that for a portfolio, just to understand the look through and the way that factors inform portfolios. Is that how clients, you think they're thinking about it?
I think that I have a sort of two-handed view of this. So there was a paper done recently where they, if you sort of use the classic three-factor Fama-French model and you regress Warren Buffett's returns against it, it turns out he has massive alpha, and it appears to be amazing. But then if you include the quality and low vol anomaly, then it appears he has no significant alpha. It's all explained by those factors. So you show up in 2016 and you run a fancy regression against Warren Buffett's things, and you go, see, I told you that guy had no alpha. That completely misses the fact that 30 years ago he identified some pretty unique things, and if you had invested with him 30 years ago, that would have been an amazing experience. So I think it's like just because I can show up and do a full sort of decomposition from a factor perspective of some series of returns doesn't mean that it wasn't valuable. And I also think that forgetting about alpha, forgetting about timing, just the ability to deliver factors consistently and in their sort of appropriate forms is a skill. You know, like if Andrew and his team can deliver to you the factors that they promise over time consistently, that's value, whether or not they do anything timing or otherwise. And so I think that you got to be careful when you go beating people over the head with regression models and talking about value add and things like that.
Great. And Andrew, let's turn to you. What do you think? Why, again, to Jim's point and Adam's point, why so much focus right now? What's changed in your mind? It seems like, Andrew, there's a lot more focus and attention right now. What do you think is going on?
And Jim made the point that there is nothing new. Yeah. And yet there is. So why now? And some of these points have been brought up, but I first think I want to reiterate that this is a very difficult time for investments, as Adam said. Probably even more now over the past couple of months that uncertainty has increased worldwide and in the US. Yields are still negative. They are rising. It's difficult. Factors help because they're tried and true. We've known about these since the 1930s, 1920s, and every time we can take these things in a low-cost way, we should, because we need to extract as much blood out of the stone as possible. We've also seen the benefits of looking through, and this has come up also, and I reiterate this point from Adam. In the financial crisis, even in quarters 3 and 4 of 2015, quarter 1 of 2016 seems so long ago. S&P 500 was down 10% at one point. We realized that putting the word private in front of equity does not create a diversified asset class to public equities. And calling something that we've learned last year an absolute return strategy as an industry did not deliver absolute returns. And it's very similar to the food that's in front of you. What really drives us are those nutrients. We can express those nutrients in different ways. We call that the mapping problem that Jim and Adam referred to. But in order to eat a healthy diet, you need to look through food and dish labels to those nutrients. And our job is to express a healthy combination of nutrients in the foods of asset classes and funds. And the third area where I see this popularity rising is we face tremendous pressures worldwide. In the US, the Department of Labor regulations may have been delayed, but they are not going away. And even if they are, investors as you well know, they demand more. Rightly so. Factors, again, help. I also believe that factors empower traditional active management. We need alpha, absolutely need alpha. And when we can find those value-added, outperforming active managers, we should pay them. But the question is, pay them with what? And if we can save money with these broad, persistent, well-known, intuitive sources done in efficient ways like ETF and long-short style funds, that saves our alpha budgets, both dollar and risk budgets, for where it's truly value-added in the portfolio. So let me make a few remarks on why I think this time is different, or rather, it seems to be not new, but yet it is. And I want to have 5 comments about why it is kind of new. The first, I'll start off with my smartphone, and I'm really unhealthily attached to my smartphone. But if I look at that phone, there's really little that's new on there. Right, we had maps and hotels, airlines, we even had coffee shops, we had car services 20, 30 years ago. None of that's new. And yet the ability to put all of that onto a phone has transformed my life. Factor investing is the phone. It democratizes access. It industrializes it, purifies it, refines it, and it democratizes those access points. And that's what's changed. Now, all of that stuff is really hard, making the phone, deciding on the factors, deciding how to engineer them. But the phone has been transformative. The second one, Jim labeled as unbundling. Now, I'm old enough, it's kind of embarrassing. There are people on my team that don't even know what a record is or even a CD. But I bought many of those things. I bought many of those things to buy a single track, a song. And I'm sure that many of you have done the same. And in the old days, you had to buy the whole record to get what you wanted. Similarly, in asset management, you had to go to one manager to get alpha, beta, and factors. And what's happened is unbundling. It's the rise of iTunes and SiriusXM and streaming TV and radio. And we've unbundled. And today, we do that in asset management. And importantly, we can pay the appropriate prices for each, alpha, beta, and factors. And we need all three, but we should be making sure we pay the right price. The third area is I have young children, and they love Lego. And you can open up a Lego set and you can make the thing that's on the box. Well, that's like the market portfolio. But you might want to make something else. And so factors allow you to do that. They're these building blocks, and you can create solutions rather than just a single fund or product. We've gone beyond that. It's not about a fund anymore. It's about using those building blocks to meet a solution. It has raised the bar. Because of that unbundling, and Jim alluded to this earlier, actually it doesn't matter what your statutory benchmark of your fund is, the one that's in the prospectus. Investors don't care. They're going to hold you to a higher standard for what they can do by themselves in either static low-cost ETFs for an active manager mutual fund space or long-short style premium funds in a hedge fund space. And that's a good thing for clients. But my final point, the fifth one, is it's not that we're going to replace active managers. It's not factors or active. It's factors and active. We need both in our portfolios. And one of the things that we've seen now, we've engaged with asset managers who have received RFPs. Some of them have come from well-known consultants that have specified factor benchmarks rather than market cap benchmarks. If we look at BlackRock ETFs, some of the largest positions in those smart beta ETFs come from active managers, not from asset owners. The most pertinent question in putting together factors and active, in fact, alpha, beta, and factors, is what Adam said, who makes that factor decision? Those factors are there. It's a question of what you do with them. Is it Warren Buffett, the manager that you hire? Is it the investor, him or herself? Is it the advisor? For an institution, is it the board? Or is it staff? Is it the internal trading desk? Or are you hiring the external manager to make both the factor decisions as well as timing and security selection? Where you take that factor decision, that's the pertinent question, not whether factors exist or not.
And Andrew, one of the things that you, with the book, you started with was, I think you said that the two most important words in investing are bad times. Why did you start the book there?
Well, I think the two most important words in investing are bad times. And in order to weather the storms that will come, we need to look through what's really driving the returns in our portfolio. And in order to do that, we have to have the factor view. And I think all three of us on this panel totally agree with that.
Yeah, I agree with that totally.
Let's see. So I've got a bunch more questions here. What's on everybody else's mind here? Any burning questions? There's one back here.
So you talked a little bit about timing. Adam, it seems that maybe possible. Some managers can do it well. Also, you mentioned maybe Andrew's working on timing. What are your thoughts on timing and whether it's possible or not? And just to sort of follow on from that, maybe what are the factors that are attractive now and least attractive now?
So I'll just make a comment, and maybe these guys can sort of follow on. I would say that for me, there's a fairly strong gravitational pull towards not trying to time. And I think that you should ignore that gravitational pull at your peril. Having said that, I think it is a natural thing for active managers who are extremely close to the situation, who are forming and dealing with portfolios on a daily basis, to maybe recognize that, hey, this factor is extremely expensive right now. I would like to have less of it. Or this other factor is extremely attractive right now. I would like to have slightly more of it. And within sort of reasonable bounds, do that. And I think that that is a source of value. But I also think that you should not be too cavalier about your ability to do that.
My 2 words of advice for people who want to time factors is please don't. So start with a long-term strategic benchmark, balance holding of factors. You then might consider tilting around there, but I agree with Adam that that gravitational center, it's that long-term strategic benchmark.
Yeah.
And actually, rebalancing itself is a form of timing. It forms a timing on valuation. It forces you to divest when things get expensive and forces you to buy when things are cheap. And if you're ready and you can do rebalancing, then you might consider other more aggressive forms. We've built a factor timing model. That research is forthcoming in the Journal of Portfolio Management later this year. Some of the other signals that we use, valuation, of course, is very important, but by no means the only one. Relative strength itself. This is kind of interesting because you get a value of value and a value of momentum and a momentum of value and a momentum of momentum. There is no, however, value of value of value or momentum of momentum. We like to look at dispersion. Dispersion measures how large the opportunity set is. So if everything is squished in terms of valuations and everything is really dirt cheap, well, what's really value versus growth? And if everything is trending up, well, how do you distinguish what's a real winner from a loser? So the wider the dispersion, the easier it is to disentangle a high return portfolio from a lower one. I like to look at healthy turnover. So that is, if you see a lot of stale positions, this is particularly true for momentum, then sometimes when they exit the portfolio, they do so with a large reversal. There's also, I like to call this diversity. I believe in diversity. If a stock is trending up, you'd actually rather that stock be trending up because that stock itself is trending up, rather than its industry is trending up or its sector is trending up or its country is trending up or generally stocks that look like that stock are trending up. So you want diverse idiosyncratic factor signals rather than concentrated systematic ones. We also look at the business cycle where you're at there. And naturally, economic intuition or rationales give us some positioning there. You confirm that with econometric analysis. At the very bottoms, the troughs, those are the time when value tends to underperform. Values very physical capital intensive factories, production lines. It's very hard to get those things to do something else. Growth firms, stereotypical growth firms, it's full of young, good-looking people. They make apps on a phone. They're trying to change the world. Well, it's easier. It's human capital rather than physical, so they're more flexible. At those times, though, minimum or low volatility strategies come into play because they're designed to mitigate risk. As the economy starts to improve, you see trends start to settle down, so momentum starts to take off. Size that Adam mentioned is highly exposed to the economic cycle. That's improving. And value has an economic, not necessarily financial leverage that the growth companies don't have. At the top of the business cycle, things get very frothy, but that's the time when you prefer companies with solid balance sheets that have more stable earnings. That's quality investing. Today, we're long value. So value remains cheap. It's done very well in quarters 3 and 4 of 2016. However, it didn't do well in 2015 or 2014, kind of did okay in 2013, didn't do well in 2012 or 2011. You probably know that in your own portfolios for value investors. So value remains cheap. But the fact that it's had a recent run-up gives it some relative strength. Dispersion as a whole is very wide, which also goes positively for value. And finally, in the economic cycle, we put ourselves, BlackRock Investment Institute has communicated this, in a reflationary growth regime, and that's also positive for value. So we are overweight value.
So just on that point, how do you measure value? I mean, what is your, Adam said, well, what do? You take price to book, you take cash flows, what's the measure of that factor?
Yeah, let me talk to you offline about that. The general concept is you want to buy cheap. And then, as Adam said, how you engineer that, there's some things that we like to look at, some backward measure. Price to book is the most standard one. You can also use an enterprise metric. We like to also look at operational sort of cash flows rather, because you can generate earnings from financial, but we view those as less reliable than operations. You want a forward-looking metric, so that would be, for example, earnings to price, forward-looking earnings to price. And you can use some others. But the general concept here is you buy cheap relative to some intrinsic value, but there is some devil in the details, and that's the value added.
A couple.
Yeah, sure.
Oh, sorry, Sammy. So I just wanted to make a couple comments about this solution orientation and comment that Andrew made. So we find, or I find, that I look across a lot of Cambridge portfolios that the number of factors that some of these portfolios harvesting is quite narrow. And if you think about, we can debate about whether there's 29, 30, 12, whatever, but it's probably more than 2 or 3. And so I think it's helpful to take a sensible look at your portfolio and say, of all the ways to harvest returns from markets, let's say all of the uncorrelated ways, so the unique ways, how many am I doing? And I think for a lot of investors, the answer is like 1 and change. There's more. The world of investing isn't super dimensional, but it's more dimensional than just 2 or 3. And a lot of portfolios are really just harvesting the equity premium, and that's about it. After the equity premium, things start to really go downhill in terms of what portfolios are harvesting. And so I think that one of the useful things that comes out of factor investing is just asking the question, how many factors am I harvesting, and why am I not trying to do these other things? Because there are very sensible and robust risk premiums that are not equity related. The entire conversation here naturally gravitated toward equity factors, right? But what about catastrophe bonds? I get paid a consistent premium to bear catastrophe risk, right? I get paid a handsome coupon all the time until the hurricane comes, then I have losses, and then I go back to earning till the next hurricane. That's a risk premium. It's legitimate, it's robust, and it has nothing to do with equities or equity markets or the economy or anything. It has to do with the weather. So why can't I harvest that? I can harvest that risk premium, right? There's lots of other things that you can look at, right? Term structure, there's all kinds of things. Volatility, option markets also contain lots of interesting risk premiums. So my point is that when you look at narrow portfolios that are only harvesting a couple factors, it is a worthwhile exercise to engage in this completion exercise, which is trying to find other sort of robust risk premium that are uncorrelated to equity markets. I think that's a very useful thing.
Yep.
It's such an interesting topic, and thank you all. I think what you're all doing is kind of raising the big question, but not addressing it directly. So the mother of all factors is equities, and perhaps the second mother is risky credit in portfolios. And I guess that was your point, Adam, about really mostly still in the one-factor world.
Right.
That's what portfolios look like. So now, instead of buying these kind of integrated packages of alpha, beta factors, very murky. We can buy really from the menu a la carte.
That's right.
And that changes everything. And we've only talked about simple factors. We haven't really talked about dynamic beta factors, which is this whole new world, big next month. So question for Andrew and anyone else who's interested, the big question is, how do you build a portfolio of factors? What do we do now?
Well, Jim?
Maybe I'll start with a really simple answer and let the smart guys take you down the road to complexity. Maybe 2 points to make about this, and if it seems redundant, apologies, but I think it's very important to reiterate. Both Adam and Andrew have addressed this, but I'll put it out there again. We've gone back and forth with the terms, factors and risk premium. And depending upon who puts research out there and measures how many factors, 10,000 of them, there's a whole second level debate about there's probably no limit to how many factors there are. But how many of them do we think will deliver a return premium? That's a very different question. So I think we'd all agree you could probably find 10,000 factors if you wanted to. The challenge now becomes about your construct is, if I could perfectly time the world, sure, I could time a factor because it's so cyclical, but it doesn't deliver a long-term premium. So I'll throw that out there as a keep that in mind. And maybe the second part to that is, again, I don't have the answer as much as there's the whole other, construct of, in a 40 Act fund world, an ETF world, I can get factor exposure, but it's going to be so highly correlated and swamped by the equity market factor because it is long-only form. The next great step is, how do I get the true form, the long-short form? Because that is what is the purest sense of the return premium. That's also where the correlation benefits will now come from, because if you can extract the bigger factors or bigger betas that are swamping the little part, that's where the real dynamic portfolio impact comes from. And I don't have the answer on how to do it, so I'll look for guidance in terms of what you two work with and look at those.
I'll offer this. It's a great point, and there's this distinction in some of the writing that distinguishing between a risk premia and a trading strategy or a market strategy. And you shouldn't say, oh, I only want to do risk premia, right? Risk premia, it's interesting that he brought up the bad times from Andrew's book. Risk premia tend to correlate strongly. One indication that you've identified a risk premia is, does it correlate strongly with bad times, right? So if you lose money in bad times, that's probably a risk premia. A big left tail outcome. So you make money frequently, and then infrequently you lose lots of money. That's generally how risk premia work. But that doesn't mean that there aren't legitimate trading strategies like momentum. You might think of momentum more as a trading type strategy, but there are some stuff out there that says it's a risk premium, but I tend to think it's more of a trade. So seasonal effects, month-end effects, right? Can I not harvest? There's a systematic month-end return that happens as a function of the way large pools of money rebalance at the end of a month and so on. Can I not capture that? Yeah, probably. But when you start to think about what are the sort of 7, 10 factors that I can, some of those will be legitimate risk premia. Some of those might be just trading strategies that tend to produce returns over time.
So we have some research on this. Please contact us for that. I think there's 2 separate problems. I'm probably not going to have time to do both. The first is, for a given factor fund, what factors should you put in? Again, Adam's question. And then what combination of factors should you do? Don't do a lot. Do more than 1 or 2, 5 or 6. Maybe it'll be a bit more ambitious, but do them really well, right? Rather than just dozens or that you don't do very well. Rebalance, you might strategically time around those strategic benchmarks. You might want to overweight certain factors that are based on the risk premium. Perhaps underweight certain factors, Adam mentioned one, like momentum, that you might have less confidence in, or are due to behavioral biases or other reasons. The second one is how should you put factors into the total portfolio? Right. And this is, what's my optimal combination of alpha, beta, and factors? So there, perhaps you might start with, if you had a benchmark, often many funds have a given benchmark. That benchmark really is an index. And if you had zero tracking error, you're forced to hold that index. Once you have some tracking error, the best way to implement that is in smart beta or factor strategies, because they're cheap, they're transparent, you know everything about them, they're well-known, intuitive, and we've discussed all the other reasons here. Once you have an alpha manager, though, you might start to allocate some of that tracking error budget from the factors to things that are very specialized and differentiated, that can time at high frequencies, that can select securities, that have networks, originate deals, all the great things that alpha managers can bring. So formally, you can write that down in an optimization where the index component, the beta, that's the benchmark. Tracking error is divided between smart beta or factors and alpha. And the higher the conviction you have on that alpha, the more that tracking error budget is going to go to that alpha.
There's another point in your question that I think is worth talking about, and I call it the concierge model of investing. It's a little bit of a jab at solutions building, but I find that the concierge model to be just sort of unsettling a little bit. A professor friend of mine from the business school was tasked with, they were building a new building for the business school, and he was in charge of interviewing the architects for the new building. And on a second or third meeting, he gets to one of the architects, and the guy says, "Hey, man, whatever you want, you just let me know. I can build it." That's not super helpful when you're trying to put together a new business school. Like, can you show me some pictures, or So this idea of let me just pick I have these factors, and let me just select off the shelf the ones I don't have and slot them in. I find that to be less effective when dealing with clients. Most people's preferences aren't super well defined across these things, and they don't have a great sense of what they currently have. And so I would just say be cautious about the sort of concierge model. It's better to, I am more attracted to sort of clear ideas about this, and to Andrew's point, focus on the plumbing. Simple factors with great plumbing is more effective than any alpha engine that you can put on top of that. I am very attracted to people with simple insights and great plumbing. And maybe that's...
my bathroom needs work.
Got a question over here.
This question is more on the business of the factor investing business. Let's assume I'm an institutional investor today that decided to get into the space. Where am I supposed to start my money? Do I go to the large houses that are focused only on factor investing, traditional asset managers who got into this, a mix of both, smaller managers? Is this a rock star hunt? Is this a teamwork? Any insight on the business of the factor investing business for those who are starting to look at the space?
This is yours, Adam.
Okay. So again, I will say this is sort of a broader statement around all the strategies, not just risk premia. And this sort of tilts in favor of the larger houses. And the reason is that I think we've thought about edge for a long time in active management, about who can generate alpha and what your edge is in alpha and everything. My personal view is that your technology budget is a good indicator of your edge. If you have been spending lots and lots of money over many years on your tech budget, building out your infrastructure, that puts you in a very good position. That's your edge. I can't, Jim and I can't go open up an Interactive Brokers account, and start going and have 10 years of $50 million tech budget behind us. We don't have that. And that is a big edge for firms that have spent the money, have the plumbing, and can execute well on these strategies. It becomes a huge barrier. and something that is not to be discounted when you're sort of evaluating these things. And so, so in that case, if a small operation with questionable infrastructure related to execution and execution technology, a deep understanding of market microstructure, the head of trading is likely to be a computer scientist or an engineer, not a markets person, that kind of thing. And that kind of framework is going to drive you to somewhat larger institutions because they've built these things out. Does that?
Thank you.
Yeah.
I have a question about performance and performance attribution. Is it more challenging to have an understandable conversation, say, with an investment committee about the drivers of stronger or weaker performance with factor investing in terms of being able to translate it to something that somebody who's less of a professional in the space can understand?
Yeah, we did some work. So Cambridge Associates, I'll tell you, we had great performance for 15 years in our sort of hedge fund portfolios. But the style exposure was fairly narrow, right? And in the last couple of years, some of those styles started to roll over a little bit. And we were challenged, and we were getting lots of questions about, hey, what's going on? And regression models were very helpful there, particularly when those portfolios are benchmarked against like a standard HFRI index or something. So you can regress the portfolios, see the factor exposure. You can regress the index and see the factor exposure of the index. And you can see differences. And you can just say to people quite clearly, look, you don't have 3 of the styles that show up in the index. You're not holding those styles. And it turns out those styles have done very well. And so be careful when you're benchmarking against an index and you're not holding all of the stuff driving the index, right? And those conversations were helped, I think, by factor decomposition. But I've also been in the other side where you show people a factor decomposition and it's like, so what? So sew your buttons on. I do think it's helpful sometimes when you do individual manager decomposition, right? And you've hired someone who is a value manager, but you run the factor models, and it turns out they're very growth oriented, or they have a lot of momentum in the portfolio. And sometimes even when you show that to the managers, they're like, "Wow, I had no idea that I was exposed to that factor so strongly." That's a helpful conversation.
I'd like to make a comment on here. Adam's comments were more detailed at the portfolio fund selector and attribution level. Let me make some comments at board level for large institutions. And this comes from my former life as an academic. I advised several large institutions, and some of them in the Netherlands and Scandinavia, where those boards have very little, and in some cases zero, investment professionals on there. And yet, all of those large institutions that all the largest institutions there actually think in terms of factors. And what the primary reason they've done so is one of communication. And I agree with Adam that this is not quanti-type reports, risk attribution type reports. And I speak as a recovering quant. Those people are very good at making simple things complicated. This is about communication to a board and saying, what are you worried about? I'm worried about Janet Yellen raising rates. That's a statement about duration risk or policy rates, real rate factors. I'm worried about inflation picking up today. Now, that's a statement about an inflation factor. I'm worried about the global economy slowing. All right? Those are all very intuitive, whereas making statements about whether I should do mezzanine debt, like what is that? What's a mortgage-backed security? Those are very complicated statements, but those other things you kind of understand. And it also extends to styles. We're going to find a manager that buys cheap. That's value. You understand what that is. All right, but I don't think going through a detailed investment process and describing Cayman versus a UCITS vehicle or a separately managed account, I don't need to do that. When does momentum do badly? Well, we're going to ride the trend, and sometimes sentiment reverses. You understand the downside to each of those things, and at those plans, it's become an extremely important communication tool.
Yeah, I've got a question, Brian. So following up on a question that I think someone else asked earlier, as an institutional CIO, is this a binary decision? In other words, is there a way for us to think about adding a risk premium manager or adding specific risk premia to an alternative portfolio? Or do we have to go all the way and say, you know what, this old model didn't work. We need to implement a brand new model. Is there a way to build some of this into an existing portfolio?
So my view on that is that it's one of these sort of arguments that they use in sort of academics sometime. Well, if you're willing to play once, well, then you'd be willing to play again, and then you play again, and then if you continue playing forever, then this is what happens. My feeling is like if you sort of buy into it enough to put it in your portfolio in a small sleeve, then the thinking that you did to arrive at that decision also probably applies to that whole bucket, and it probably also applies to the larger bucket, and then it actually applies. The thinking that we did to get to this investment is that we should be applying that at the broader level. And it comes back to this like default. Just think about default risk. I'd like to do default risk. That's a risk premium. How can I most efficiently do that? Doesn't it make sense to work up the chain and look at our total portfolio and go, how many of these things are we actually doing? If I'm doing a 2% position in a diversified risk beta fund, does that really matter if I'm doing 98% in the equity risk premium? That kind of doesn't feel right, right? So I think that the logic just naturally moves up the chain if you kind of buy into it.
The BlackRock partnered with the Economist Intelligence Unit last year to conduct a survey of 200 large institutions, global, on how they're looking at and using factors in their portfolio. And there are a couple of use cases that came out of there. I'll just share a little bit, but if you'd like to receive that, please contact us. The first one is that you would just pick a factor fund. Now, admittedly, this is nothing special because you're going to outperform the market. You just happen to outperform the market with factors rather than through some other active management process. The second one is very interesting, is that of the investors taking on these factors as an investment strategy, and that's the majority of them, 20% of them are doing it in a carve-out portfolio. Right, the carve-out's kind of interesting. So, again, just speak from personal experience here. Large institutions often have legacy programs. They work. And in equities, say, they're oriented around active manager selection, sometimes in traditional vehicles, active mutual funds, say. But the factors are different. You have to do a due diligence methodology on the index construction, the execution mechanism, all the things the plumbing that Adam said. That's different. You still have to meet the manager, but you have to do all this other stuff. It might be a new vehicle, right? An ETF compared to a mutual fund. And sometimes putting that together in a legacy program is like mixing oil and water. You want the benefits, don't want to touch what's working, you carve it out. Right? Another reason is these things are new. And if you just have one fund and they're one of dozen funds, really how much attention do you focus on it? But if it's a carve-out, it's a separate line item and you really focus on it. And you should, because it is new, it deserves attention. And the final one is it's only an incremental change to have a carve-out. And the carve-outs aren't new. We didn't used to have carve-outs for real estate or carve-outs for alternatives. Now we do. They're standard. The only thing about this is there's a carve-out for factors. But the whole machinery for many funds, the consultants that they engage with, the boards that they receive reports on, is oriented around asset allocation. There's nothing new about this. It happens to be a new asset class. And so all of that you can keep, but you still get the benefits from that.
Great. Other questions? I want to thank our panel. I thought that was a really interesting conversation that we all had here. So any more follow-up, I think they'll be here for a little bit. You can chat with everybody, but I'll hand it back to Ray.
Very good. Brian, thank you. This was an outstanding panel. You did a great job. We meet again in this room on March 23rd. Dominic Napolitano is going to lead us in our next session, which will cover healthcare investing, a very topical area, and should be a very lively conversation. So once again, thanks to the panel, thanks to Brian, and we'll see you all in a month.
Right.